Welcome back to the Lance Roberts Show podcast. I'm your host, Lance Roberts. John Coumarianos here as well, our analyst for Real Investment Advice. Be sure to get by our website, realinvestmentadvice.com. Click on our YouTube tab for all of our podcasts that we have every day. And today, we're very happy to be speaking with Jeffrey Sherman from Doubleline. John, you had a question?
Absolutely. Jeffrey, we wanted to take it back to the funds. First, back to the core fixed income fund, and then we'll get into maybe the commodity and the new real estate fund that Doubleline has out. But on the core fixed income fund, I think we got the message that you're not a big fan of traditional investment grade corporate credit, and so you're using a lot of structured product, which of course Doubleline, in which Doubleline is an expert. But you do have a position in emerging markets debt as well, almost 8%, and those bonds were down last year, up like gangbusters this year. But you've held the position, it seems like, based on the last few portfolio reports. Tell us about the position and emerging markets in general.
Yeah, so there's two kind of international type of investing we've been doing more of in 2019. One is the emerging market space, as you'd mentioned, but also just international sovereign debt, as we really think the dollar is showing signs of just tiredness and peaking at this part in the cycle. So we think some non-dollar investments are important to own in 2019. But going back to the emerging market space, our team was very conservative, our EM team specifically, going into 2018 for the fact that we didn't think they were getting paid for interest rate risk or really a lot of corporate risk out there. But it made sense to sell the exposures in the market, but just do it at the higher end of the quality spectrum. And so the team late in 17 shifted to having more sovereign debt within the EM space and less corporate debt, and doing it in really about 92 or 93% of that allocation to EM was actually in investment grade rated names. As there was a sell-off that started really in late March, early April, right around the time of the tariff talk and the trade wars, as people call it, there started to become some weakness. So starting in early June, the team started taking a little bit more risk within their EM allocation and built that throughout the year. When we did the year-end review at the end of December, and we're talking from our asset allocation committee about what we should be doing across the credit markets after there was a lot of weakness in the fourth quarter, you had high yield spreads that were wider than EMD, but we didn't like the overall outlook because we've been talking about the corporate debt just in the investment grade market. If there is some downgrade wave, we'll put pressure there. So we liked the EM side. We thought that the dollar wasn't really going to present a headwind in 2019 to that, to the overall economies. And so we decided to add a little bit to that allocation. So it's increased to about 9% since that time, John. Not a big move because we want to start legging into the trade a little bit more. The team was also taking more risk. And I'd say about 40% of that allocation to the EM sector, so 9% of the fund, but 40% within that, is below investment grade today. So we started to take a little bit more risk there. So even though the allocations haven't changed on a dollar basis or a percentage of the fund, we have been actually changing the risk exposures. But one move we made at the end of last month was essentially to sell some of the U.S. securities and buy some non-dollar assets. And this is just simply a view on the dollar.
Right.
And again, we talked about the glut of supply of treasuries. Treasuries are printing money by definition. If you're creating them, you're creating money supply. And ultimately, that should put some pressure downward on the dollar as well. So those two things come together to get that position. So if you look at the portfolio, about 12.5 to 13% of the portfolio sits outside the U.S. today, which is one of the larger weightings we've had to the sovereign non-U.S. exposure.
Right, and that served the fund well. I mean, the fund's up, I think, 1.5% year to date through yesterday. It's in the top third of the Morningstar category, and that's been that's where it's been really top quartile for the 5-year. Sorry, top decile for the 5-year period, posting 3% return, 3.05% through yesterday.
Well, I think the other thing, if I could cut you off and really emphasize, the team here, we're really focused on risk management. So it's great to have the great performance, but we think managing throughout a cycle requires discipline, trying to assess risk you see in the marketplace, and don't just be blindly following what are the trends in the marketplace. And so, yes, if there's good trends underway and the fundamentals support them, you need to be allocated. But the key here is risk management. And so I think what we're most proud of here in our Doubleline family is not just having top decile returns, but also having kind of bottom quartile to bottom decile when it comes to the absolute risk on the funds. And so, if you put those two things together, as John, you well know, that's called a Sharpe ratio.
Sure.
And our goal is to deliver, high return per unit of risk. A lot of investors like the Doubleline funds for those reasons because, you don't get some of these wild swings. So we talk about core fixed income, having a big piece to our emerging market exposure. our emerging market exposure last year, if you carved out that sleeve performance, it was only down about 1.5%,
right,
where the broad market was down 6 or 7. So I give kudos to my emerging market team for helping us manage through that. And again, from an asset allocation perspective, making sure we're pulling those levers. So just want to give you a quick plug and shout out to our risk management team as well.
Sure. And
well, I think the risk management aspect of that is probably the most important component here, because really that's the one thing that investors, by and large, do. They may not realize they want it, but when you get a market downturn, people realize really quickly they like risk management.
Especially in your bond funds. You don't want your bond funds to go down.
I get it all the time. Like, we want all this return. I want 10, 12% yield and all this stuff, but do you want the drawdown associated with it? And
right.
Even a year like last year, we had a tough year that we only made. I think net of fees, we were down 1 basis point last year.
Yep.
It's a negative return is never fun, and we gave that back like the last week of the year.
Yeah.
Right.
But ultimately, the Barclays Act eked out a gain. It was up 1 basis point.
1 basis point, right?
We had this massive underperformance of 2 basis points last year.
Yep.
Yeah.
Which I still hate that, right?
Yep.
But ultimately, it's positioning, it's making sure you're investing for the future. And the good news is last year is we got to build the yield on the portfolio up as interest rates were higher, and so the earning potential is much better in the markets today. And again, risk management is very important. It's what we focus on, and so. We're willing to pass on opportunities if we think they have a lot of downside.
Well, and this is the thing I wanted to ask you about, the risk management side of this, because we are seeing global economic weakness. We are seeing some concerns about domestic economic weakness in the first quarter of this year. Really and actually the economy's been slowing over the last couple of quarters. It's going to be more pronounced in the first quarter of this year, according to some of the recent data. But emerging markets are very susceptible to kind of the global environment in general, because they're basically a lot of net exporters to a lot of countries. And with the concern over talking about risk and talking about cycles in general, we're 10 years into an economic cycle here. Is the expectation that we're not going to have a recession again at some point in the future? What's the longer term view on risk relative to emerging markets, domestic markets, and international markets?
Well, the one thing about the emerging markets is that they've already been through their default cycles, and they've cleaned up their balance sheets in their last crises, right?
Right.
Where the developed world didn't. We actually exploded our balance sheet, increased government debt significantly during those periods. So I would say from a secular perspective, they're better positioned for the long term. But as you mentioned, a lot of them are dependent on the global economy. Mm-hmm. And really the big overhang to the global economy, I can attribute to 2 sources today. One starts with Brexit, where that's challenging the Eurozone. I think a lot of the stress you're seeing there is the uncertainty behind Brexit. What's going to happen? Supposedly, we get resolution in roughly 3.5 weeks on what's going to happen there. Are they going to leave? Are they going to stay? Is it going to be a hard landing, soft landing? All those scenarios that no one knows about. But that is something that's led to essentially a curtailment of investment, which slows that region down. And the other one is self-inflicted by the U.S. And this is from the administration. These are the tariff policies and the trade war we have solicited with China. Mm-hmm. And essentially, that's solvable, right? Essentially, the president can send, and President Xi or Premier Xi can come out and actually, stop the tariffs and stop the trade war and get to an agreement. And that can send us back off to the races again. But going off to the races in terms of global GDP doesn't mean that equity markets or risk markets haven't already priced it in. And so the thing about the tariffs, if we got, what I'll call trade peace, that's what we call it around here. It's the opposite of trade war, right? If you get trade peace, and we're in California, so we try to be a little more, tune into the hippie, peaceful community, right? But ultimately, I think if you got something like that, that's the end of kind of the risk asset for the time. They've already priced that kind of news in, but it could set us the stage for a continued expansion. So remember what we're talking about here. We're talking about slowdowns. We're not talking about recessions yet. Although the data out of Germany has been a bit scary because they have had some negative GDP. They had a negative GDP print. And if you look at the survey data, their manufacturing looks low. But I would attribute a lot of that to the trade war. Remember, it comes out of Germany. Mm-hmm. Secondly, you have Brexit there, which they're getting affected by. And third, the president had threatened tariffs on European autos as well this month. And so that was something that has been some curtailment there in some of the consumption as well. So you still need to stay on watch there. They always say that expansions don't die of longevity or the tenure. It simply happens to usually malinvestment. And typically that comes back to leverage and the amount of borrowing in the system. So there's a lot of variables out there. These are the things we discuss at our asset allocation meetings when trying to think about the risk out there in the overall global economy. And again, although we have increased the allocation of some of these non-dollar assets, it's not like we're buying corporate credit in a lot of these kind of developed international worlds.
Got it. So, I mean, that's a great point. So basically, resolve the trade war, no recession ever again, go long equities. Got it.
Hey, the other thing is if you don't forget, Ms. Yellen, before she left, said we'll never have another financial crisis in our lifetimes.
Yeah. No, she said in her lifetime, and she's old as dirt. So
I did actually say that on the trading desk. Did she mean her own lifetime? And does she know something that we don't know?
Exactly.
But ultimately, recessions, people are so fearful of recessions, right? Because the last two that we really had were ugly, right? But why can't we have just a shallow recession, right? And I think the reason we can't is because of the amount of debt out there and just how it could spiral so quickly. But we did kind of have a profit recession, if you recall, back in 2015, early 16. The S&P 500 had 5 consecutive negative quarters of earnings growth, or earnings declines, you should say, right? The commodity market fell off a cliff. Oil went from about $105 a barrel down to, I think it bought around 26 or so intraday. I mean, these were big impacts over short periods of time.
A lot of pain in the junk bond market, as I'm sure you remember as well.
Yeah, it was tough to own credit.
Sure.
And we navigated that one pretty well. We were very proud of the way we sidestepped a lot of that. But ultimately, that's what led us to this coordinated global growth story. We had a repricing of risk assets over the course of roughly 7 to 8 months. And we had a scare in the equity market. And ultimately, 1 month later, if you recall, from the bottom in risk markets in February of 2016, 1 month later, Janet Yellen raised rates, right? So the idea was that we're starting to get this inflationary data back. And so, again, I don't know how to read the Fed today. They're very confusing. They've been flip-flopping back and forth on their policies. They seem to have got this coordinated message now that they're going to do whatever it takes to save the market. And I'll be very curious to see, and we'll be tuned in with all of our eyes on the trading desk at Mr. Powell's speech in 2 weeks' time at the Fed meeting.
All right, quick break. We're going to come back with Jeffrey Sherman from Doubleline, and we're going to talk about the real estate fund when we come back. They have a fantastic real estate fund. But I wanted to talk a little bit more about real estate because we have seen a slowdown in housing and a lot of the economic data. A lot of it had to do with the rise in interest rates. So we'll come back and talk about opportunities with real estate right after this break.
You can get daily real investment news you can use, delivered at the speed of the internet. Sign up for Lance's newsletter now at realinvestmentadvice.com.